And we have some news just out literally moments ago. Nielsen, the company, is spinning off its global Connect business into a separate publicly traded company. Joining us right now with that news is Nielsen Holdings CEO, David Kenny. Good morning.
Good morning, Andrew.
So let's talk about this because it's literally just happening.
It is.
Yeah.
So I'm excited about it.
So explain what's happening because this has been a long time in coming.
Well, yeah, I got here 11 months ago, and most of that time has been spent looking at two multi-billion-dollar businesses. One is the Connect business, which measures what everybody buys in supermarkets and drugstores in over 100 countries. It's the backbone of the way that world works, the consumer retail world and CPG world. And the other, of course, is the media business that rates everything that people watch on every screen, which is the source of truth. Two great franchises, but had very little to do with each other. Different margin structures, different investments. And in the end, I believe that our shareholders are going to get the most value by being able to trade both separately.
Okay, so here's the question. So once these companies are separated, if you are an investor looking at these two entities, you're going to start to think, what kind of multiple can I put on each? And how are they going to look separate? What are the comps? What are the other comparable companies that I would look to for a multiple to put on each of these businesses? How have you thought about that?
Yeah, well, ultimately, because these are sources of truth, they don't tend to have direct competitors. What they tend to have is derivative of the markets they're in. So in the media markets, you're going to look at the growth of the media industry at large, because almost everything is rated by Nielsen. And you're going to also see that's a syndicated business, so the margins are in the 40s. And put that multiple. The other business is going to grow the rate of the packaged goods business, so it's a little bit slower growth. Its margins are more in the teens because it costs more to collect all that data. So they're just two different businesses.
When you say you're going to input that multiple, I imagine that some bankers sat at a boardroom table with you.
Lots of bankers.
And lawyers. And they told you what input of the multiple that you would put. So what was that number? What are those numbers?
I'm not going to share what we discussed in our boardroom, and ultimately the market's going to decide today when it trades. That's what it's worth.
The other way to look at this is, back in 2016, your stock was a $56 stock. It's now a $20 stock. Presumably, the desire to separate these businesses is going to unlock a value. So what is the sum of the parts analysis? I mean, if you must have done that. What should the stock be worth based on that?
Listen, our board took a very deep look at the business. To put an exact number on it doesn't actually make sense here. I think that because we trade, we'll know in a little bit of time how it trades. We certainly do believe that the value is higher over time as these companies trade separately because the investors have a different profile and put them into different portfolios. So we certainly do believe this unleashes value. I also think it unleashes a lot of operational and executional focus. The folks in Connect are very excited to be on their own and be building their business. And I think the media business is going to see a lot of new investment because media is changing.
Where's the faster revenue growth between the two?
The faster revenue growth is in the media business.
And that's where you're staying?
That is where I'm staying.
And are you staying?
I am. Yes, I have agreed to. First of all, it's going to take me 9 to 12 months to separate. So I'm going to run the whole company for quite some time. When we separate, I have already accepted the position to be the CEO of the media company. And we're looking for a CEO of the Connect company. There are some great internal candidates and some great external candidates as well. And we'll announce management sometime in the near future.
And when you look at these two businesses operationally, do you actually think that there's a genuine operational distinction between them?
They're completely different.
And they should have never been together to begin with?
I don't know that it made a ton of sense. There was a logic years ago because they were separated.
Right.
And when they were put together, the belief was, well, boy, if you measure everything people watched and everything people buy, it could correlate. Right. The reality is what we measure of people buying is packaged goods. That's only 9% of advertising.
By making this announcement today, is there any, and I don't know enough about the tax implications for this because I know you want to do it as a tax-efficient spinoff.
Yes.
Is there any chance, and have you explored, and has anybody come to you in this process, an acquirer for either or both of these businesses?
We had a lot of options. A lot of people came with different plans for the business, and we looked at all of those and compared them to this plan, which is going faster on the plan we're on. And in the end, we concluded this was the very best plan for our shareholders.
So but there's nobody who's going to sort of jump out of the bushes here and say we want to buy the Connect business or we want to buy the media business now.
There's nobody I'm aware of. You never know what's going to happen, and we're a public company. We always will be open to opportunities. But by and large, we have closed the strategic review. We're focused on operations right now, not on deals discussions.
And by the way, is the reason to do it as a spinoff as opposed to selling it, is part of that a tax issue?
Absolutely. It's a very tax efficient way to deliver value to the shareholders.
Okay. David, thank you.